In the world of investments, a new wave is reshaping the landscape. It's called sustainable investing, and it's more than just a trend. This is the Good Life Club, and we teach you all about personal finance, so let's dive into what this means for you. Sustainable investing is gaining traction, both for individuals and institutions. It's about putting your money where your values are, aligning investments with environmental, social, and governance criteria. We often call it sustainable for simplicity's sake. In an era marked by a growing concern for environmental and social issues, a significant shift is underway in the world of finance. Individuals and large institutions alike are increasingly directing their investment dollars towards strategies that align with ESG, environmental, social, and governance criteria. This movement, often referred to as responsible, sustainable, or green investing, aims to marry financial returns with positive societal impact. Throughout this video, I'll use the term sustainable investing to encompass these strategies, delving into their intricacies, challenges, and implications. According to the 2018 Global Sustainable Investment Review, the tides of change are evident in the statistics. As of the beginning of 2018, over 25% of assets under management in the United States were invested in sustainable strategies. The momentum is even more pronounced in Canada, where over 50% of assets amounting to a staggering 2.1 trillion Canadian dollars are now committed to sustainable investments. This represents an impressive 42% increase since 2016, reflecting a profound shift in investor preferences and priorities. BlackRock, a titan in the world of asset management, has recently solidified its commitment to sustainability, signaling a monumental shift within the industry. The fact that such a heavyweight player is integrating sustainability into its investment process is a clear indicator of the movement's growing influence. While the surge in sustainable investing brings potential for a positive social impact, it also raises pertinent questions about its implications on investment outcomes. Diving into the strategies that define sustainable investing, two approaches stand out: negative screening and ESG integration. Negative screening involves selectively excluding specific sectors, companies, or practices from a portfolio. In contrast, ESG integration takes a more nuanced approach by reweighing companies based on their ESG scores. This approach doesn't entirely eliminate industries. Rather, it underscores a deliberate effort to underweight companies with lower ESG scores, while elevating those with higher scores. Many index funds leverage a combination of these strategies, acknowledging the multifaceted nature of sustainability considerations. Sustainable investing appears undeniably appealing on the surface, aligning financial interests with ethical convictions. However, this allure is not only the beginning of a complex decision-making process. To make informed choices about sustainable investment strategies, two critical factors demand attention. The first pertains to the impact on expected returns, while the second involves the degree to which the investment aligns with personal views and values. Balancing these considerations is pivotal, demanding a holistic assessment before embarking on a sustainable investment journey. Turning to the relationship between sustainable investing and expected returns, a 2019 study by Rocco Cicciretti, Ambrogio Dallo, and Le Merchant Dam offers intriguing insights. Analyzing a global sample of nearly 6,000 firms spanning 2004 to 2018, the study uncovered a distinct pattern. Companies boasting higher ESG scores tended to deliver lower average returns compared to those with lower scores. This trend persisted across various regression models, substantiating the assertion that high ESG scores correlate with subdued returns. Two distinct theories underpin this phenomenon: investor preferences and underlying ESG risk factors. Notably, empirical evidence favors the former, suggesting that investor preferences play a pivotal role in the observed negative ESG premium. Investors seem willing to accept lower expected returns to avoid certain types of firms, underpinning the idea that ESG investing is largely driven by an effective investor taste. This appetite for sustainability can shape investment outcomes, altering the expected returns of both sustainable and unsustainable companies. Eugene Fama and Ken French, in their 2007 paper Disagreements, Tastes, and Asset Prices, elucidate the concepts of investing based on preferences rather than expected returns. Investors may hold assets for reasons beyond financial gain if they have a taste for them. When substantial wealth is controlled by individuals with specific tastes, as is the case with sustainable investors, their actions influence market prices. This dynamic extends to the fact that investors with a penchant for sustainability require higher expected returns to be enticed into unsustainable companies. In turn, this dynamic inflates the expected returns of unsustainable entities while deflating those of sustainable counterparts. This connection between investor tastes and sustainable investing is further illuminated by Olivia David Zerbib's 2019 model. Zerbib's model integrates premiums for ESG exclusion and investor tastes, quantifying their impact on returns. Analyzing US stock data from 2000 to 2018, Zerbib found an exclusion effect of 2.5% per year and a taste effect of 1.5% per year. These figures underscore the magnitude of underperformance associated with negative screening and an integrated approach to sustainable portfolios. The intensifying prevalence of strong ESG preferences magnifies these pricing effects. In a 2019 paper, Lubas Pastor, Robert Stambaugh, and Lucian Taylor crafted a theoretical model to investigate ESG's impact on expected returns. Their findings echoed the prevailing theme. Firms with higher ESG scores experience lower expected returns. This trend becomes more pronounced when risk aversion is low and ESG sensitivity is high, rendering sustainable investing a dynamic realm shaped by preferences and risk profiles. This intricate interplay of preferences culminates in an intriguing observation. Sustainable investing engenders positive social impact but concurrently dampens expected returns. This paradox hinges on a fundamental truth. If sustainable investing fulfills its mission by pressuring unsustainable companies, these excluded firms must offer higher expected returns to entice investors. Consequently, the expected returns of sustainable portfolios reflecting investors' unique preferences are inherently lower. To sum up this intricate web of relationships, sustainable investing, while capable of instigating positive change, entails a compromise in terms of lower expected returns. This trade-off assumes a more pronounced form in portfolios incorporating negative screening, which targets specific industries. In either case, investors harboring above-average ESG preferences must grapple with the reality of lower expected returns, which are mirrored in their portfolios. However, diminished returns are just one facet of the challenges encountered by sustainable investors. An inherent trade-off in sustainable portfolios arises from their reduced diversification compared to the broader market. This reduction in diversification compromises the reliability of investment outcomes, amplifying the risk profile. This trade-off becomes less palatable when considering that companies with higher ESG scores are associated with lower expected returns. The outcome is an investment strategy that offers less reliability and lower returns, a suboptimal scenario that demands careful consideration. Adding another layer to the equation are fees. A globally diversified portfolio of Canadian-listed iShares ESG ETFs demands an annual cost of around 0.28%. In stark contrast, a comparable iShares ETF portfolio devoid of ESG considerations costs a mere 0.12% per year. These escalating fees intersect with the lower expected returns of sustainable portfolios, presenting investors with a challenging landscape. This confluence of factors creates a continuum of costs. The more sustainable the portfolio, the higher the costs tend to become. To exemplify this spectrum, consider two ends. XIC, the iShares Core S&P/TSX Capped Composite Index ETF, stands as a no ESG filter option with a 0.06% expense ratio. On the other hand, XESG, the iShares ESG MSCI Canada Index ETF, leans toward high ESG scores, offering 129 holdings and an expense ratio of 0.22%. The Desjardins RI Canada Low CO2 Index ETF occupies a more stringent stance, boasting stricter ESG criteria and higher exclusions. Its 0.29% expense ratio reflects the evolving trade-offs as sustainability commitments deepen. The crux of the matter lies in the alignment of investments with personal values. This is where the nuances and challenges of sustainable investing are most apparent. Despite the burgeoning ESG landscape, the variance in definitions and measurements of sustainability across rating agencies is notable. A 2019 study by Florian Berg, Julian Colbell, and Roberto Rigobon highlights the divergence between ESG ratings from different agencies. Their average correlation of 0.61 reveals significant discrepancies, driven by variations in ESG definitions and measurement approaches. Consider, for instance, the MSCI Canada IMI Extended ESG Focus Index, which integrates ESG principles while allowing some exposure to energy companies. This approach contradicts FTSE, which excludes oil, gas, and coal companies in its ESG indexes. Such differences reflect broader challenges in constructing ESG indexes that resonate with investors' values across multiple issues. This disconnect creates a dilemma for both investors and companies, compounding the complexities of sustainable investing. Ultimately, successful sustainable investing requires a precise balance between implicit and explicit costs, as well as personal views and values. Investors must navigate the delicate trade-offs, weighing diversification, expected returns, and fees against their ethical convictions. As ESG preferences grow more distinctive, these considerations will assume even greater significance, underscoring the need for a strategic approach. As you navigate the intricate landscape of sustainable investing, remember that every choice involves trade-offs. By aligning your investments with your values, you can make a positive impact on the world, even as you navigate the complex interplay of financial returns and ethical commitments. Until next time, stay informed, stay curious, and make decisions that resonate with both your financial aspirations and your convictions. If you have any questions or would like to delve deeper into this topic, watch our other videos about personal finance here on The Good Life Club. Live your best life.